Welcome to the Financial Co-Pilot podcast and video channel, where airline pilot and CFP professional Dan Lomar shares techniques, interviews, and perspectives about financial planning and life in general for airline pilots. Here's your host, Dan Lomar.
How's it going, everybody? Welcome to another video. So obviously, in both the stock market and the bond market, we're seeing negative returns year to date. And so what does that imply for somebody in retirement and having to live out their investments? So here we are, you worked all these years and now you get there and we're pulling money, you're pulling money from your investments to live off of, but we're also seeing the value of the decline. What are some of the things we take into account when it comes to planning for that and how we actually deal with it in real time? So that's what I'm talking about in this video. And if you're a current client, hey, this is be a great review as to what we're doing with your portfolio of things that we're thinking about right now. If you're not a current client, hey, listen up, because this might be something that you and I can sit down and talk about how we can take care of that for you. And if you're not retired yet, hey, listen up, because this is a great thing to consider as for your own planning purposes, that when you get into retirement, things you can take into account when you get there. So we're talking about kind of, retired during a bear market. Hey, don't take this as tax, legal, or investment advice. You decide whether the strategies that we use, you decide whether they work for you. And if you haven't done it, remember to subscribe, hit the bell icon so that you know when new videos come out. And I've got a checklist down below for just general financial considerations during a bear market, things to kind of take into account, and it's whether you're retired or not. So that link to download that checklist is going to be in the show notes in YouTube. Please feel free to download that and take a look. So, all right, retirement income planning. The big thing we're looking at when it comes to designing a retirement income plan in retirement, we're living off of our investments. We're trying to balance two things. Just like any financial decision, we're trying to balance a couple of things. We've got a reward, we've got a risk. We've got to kind of balance those things out to try to make them fit into your particular situation. So what is that? What are we balancing when it comes to retirement income? Well, we're trying to maximize retirement income or maximize your lifestyle, but we're also trying to maximize the longevity. We're trying to sustain that income for as long as we can so that you don't run out of money. My investment partner, my business partner, Alan Bewley, he said it the best. He said, hey, there's two phone calls we don't want to get. And that is, one, hey, Dan, I'm on my deathbed and I've got millions of dollars that I never spent. And number two, hey, Dan, I'm 90 years old and I'm out of money. So those are the kind of things that we keep into mind. You got to have to balance those two things out as we do that. So that's kind of what we keep in mind. Number one thing we do when it comes to creating a retirement income is diversification. So stocks, stock mutual funds, diversified, globally diversified across all sectors. Okay, that's the engine of the portfolio. That's what's going to keep it growing. That's what makes it last as long as what we do. Now, how aggressive you are is up to you. You can be 70% equity, 60%, 50%, 40%. So a lot of that depends on you and your plan, but the stocks are there to keep the growth there. That's really what adds to the longevity for the most part. And two, bonds provide a stabilizing factor. They don't usually have the typical volatility. And when I'm talking about bonds, I'm talking about investment grade, high quality bonds. I'm not talking about high yield bonds, junk bonds, anything like that. And then we're also talking about cash. So we're diversified between bonds, stocks, and cash. Cash is your short-term income. So we look at your plan, we say, how much income do you need in the next 1 to 2 years? And we set that aside. So we like to aim to have 6 months to 2 years of income in cash so that that's not exposed to the markets that we're seeing, both the stock and the bond market. And then we monitor that cash position. Hey, how down, how low is it getting? How much time do we have? How much time we anticipate? So that's one of the things we look at. So number one, diversification. Now, diversification, one of the benefits of diversification that we expect to see is that a lot of times, and not always, but a lot of times when the stock market goes down, the bond market, at least the investments that we provide, that we invest in, those bonds are stable, and a lot of times they might actually go up. We saw that in March of 2020. It worked perfectly. We saw a lot of softness in the stock market, but our high quality bonds actually held up and actually went up during that month. So that's exactly what we see them to do, but we're not seeing that this year. We're actually seeing rising interest rates, and that's because of the inflation concerns, and that's causing a big headwind for the bonds. So we're actually seeing both stocks and bonds with some negative returns year to date. So kind of an interesting situation there. So the number two thing we do as we kind of monitor this position is we look at and we say, hey, where do we stand with Social Security and other pensions like PBGC? Where do we stand? Did we start those? Are we delaying those? And what can we do to turn those on? Now, I just did 2 videos talking about the benefits of delaying. Why would we delay Social Security and or PBGC? And the biggest thing is because of longevity. It's 2 sources of income that we cannot outlive. So we would prefer those incomes to be as high as possible, and they get to be as high as possible by delaying to age 70. And that's what we're talking about. But and that's the benefit of delaying those 2 things. But I also said, when would we turn them on? When would we start them earlier? We would start them earlier if we see negative returns in our portfolio, which is kind of what we're seeing right now. But again, there's a lot of things to weigh into that. How much cash do we have? How quickly are we burning through the cash position? So that's in the number 2 consideration is where do we stand with Social Security, PBGC? Can we turn it on? And which would begin to help minimize the drawdown of the portfolio. So that's the number 2 consideration is turning on Social Security PBGC. And I'm going to show you here in a minute a graphic of what that looks like and the difference that can make if you were to turn that on ahead of time or earlier than planned anyway. So the next thing, number 3, foregoing a pay raise. So you might say, hey, look, again, what we're trying to do during times of negative returns is trying to minimize the drawdown of the portfolio, the drawdown being both withdrawals and performance. So we might say, hey, look, I'm not going to take a pay raise. That's one of the things we do. Now, the big benefit of that really is if you start with a plan that says, hey, I'm okay not taking a pay raise unless the portfolio suggests I should, unless the performance of the portfolio suggests I should. Okay, the benefit of that is that it allows us to take out a bigger amount to begin with. Because if you insist on having a pay raise year after year after year, you only have one choice, and that is you have to start at a smaller amount. Okay, so that's the benefit is if you just say, hey, I'm okay not taking a pay raise unless the portfolio performance says I can take one, then that's the benefit of it. It's just saying, hey, look, I can take out a little bit more. And so that's okay. So consideration not to take a pay raise is the number 3 thing to take into account there. Number 4, and a little bit more extreme, instead of not taking a pay raise, it might come to taking a pay cut. Okay, so again, if the portfolio really starts to draw down there, we implement a strategy we use called guardrail, income and portfolio guardrails, where we have predetermined portfolio values that determine when we take a pay cut and when we take a pay raise. And so depending on the asset allocation, your aggressiveness, on how willing you are to take a pay cut or how much you need to have a pay raise, a lot of that comes into play as to where these guardrails are going to be. But fairly typical is anywhere between 15 to say 20% below your starting value is where that first guardrail is going to be. And if you get down to that point, then it would say, hey, look, we're going to have to take a pay cut to do that. Now that pay cut might be 5 to 10% of your total income, which means the cut to your portfolio withdrawals is probably going to be even a little bit more than that, depending on what sources of income you're using at that time, depending on whether you're taking Social Security, PBGC or not. So that's the next thing. That's kind of the 4th step is that we have to take a pay cut. Again, the advantage of having that flexibility, the advantage of having the willingness to say, hey, I'm willing to take a pay cut. The advantage of that, this trade-off we always talk about, is that it allows you to take more out up front. It's kind of allowing you to say, hey, look, I'm willing to take more up front. I'm willing to take a pay cut if the portfolio performance says I can take a pay cut. Because if you take more out front and the performance supports that larger amount, hey, so be it. You're spending more than what you're spending more than what you could is if you weren't willing to take a pay cut. That's kind of what the benefit of that flexibility is. So let's talk about implementing this plan and kind of what it looks like. I'm going to show you 2 periods in history. And the first one I'm going to use is the financial crisis. We're looking at a 50-50 portfolio, 50% stock mutual funds, 50% bond mutual funds. We're starting with about $2.1 million. We're drawing We're taking into account what Social Security and PBGC are going to be. We've already started PBGC in this situation. And so we're supporting a monthly income of $15,000. That's what we're trying to support. That's a gross income of $15,000 is what we're trying to support. No, this is starting this plan at the worst possible time in history, probably. Okay, so 6 months before the financial crisis. So so right at the top of the market, over the next 18 months, the market corrects. We're taking money out of the portfolio. What does that look like overall? Right now, if we look at, and we're taking the Social Security, delaying it to age 70. So we see pretty stiff drawdown during that portfolio during the first 18 months. Okay, we hit a guardrail. I think it's about 17 months into it. We hit that lower guardrail. The guardrail says, hey, look, let's take a pay cut. And then that's going to trigger a 5 to 10% overall pay cut. The bottom of the portfolio bottoms about, I think it's about 21 months into the sequence here. Point 21. And then it recovers. Now, it has a hard time recovering because we have not started Social Security yet. So let's take a look at that. Let's just say we plan on taking Social Security at age 70. And then in the middle of it, we say, hey, look, our cash position's getting low. Let's turn it on. We change our starting age to age 66. And now what we see, it didn't prevent a pay cut, if we see that, but it did definitely help the portfolio recover a lot more soundly in that situation. So we kind of see what the guardrail looks like. We kind of see what the difference is when we, if we are to change our minds and take Social Security earlier rather than later. And then in these guardrails float. So in this situation, these guardrails are static. It's just too difficult to program flexible guardrails into this based on the criteria that we're using. And so in this case, once we hit that lower guardrail, these guardrails would have flexed down also. And so you probably actually, as this thing recovered, you probably would have actually taken a pay raise somewhere in here and brought you back to what your original income was. The other thing too here is I'm not giving an inflation adjustment. So this is just a straight withdrawal. $15,000 a month. And actually I did institute a pay cut right here, but I did not give a pay raise back anywhere in here. So that's just kind of give you an idea of what that looks like. Now let's look at another worst case scenario. And that is during the dot-com bust. Let's just say we start in January of 2000. Again, we have a bear market for about, oh goodness, we have a bear market for about close to 2.5 years. So I think this goes to March of 2003. And so this is kind of what it looks like. Again, 50-50 portfolio, exact same situation. We're pulling out the same amount. Let's go 1,500 here. $15,000 a month, and that includes our income from Social Security and PBGC is what we're supporting from that. So as we look here and we're taking Social Security at age 70s, we see a drawdown. We never get to the bottom guardrail. However, we might have seen one. So later on during the years, this is the financial crisis. Social Security is turned on by this point. And so we do actually take a pay cut during the financial crisis. Now, that's not necessarily so either because, again, these income guardrails float and they also depend on your time horizon. So this would have been 7 years in your retirement. So it's a little bit different. Actually, this would have been more like 8 to 9 years in your retirement. And so that's a little bit different. So your time horizon is different. You can support a higher withdrawal rate. So just to kind of show you an example, kind of what these things do, these are the big strategies that we use when it comes to implementing a retirement income portfolio. So number one, diversification. Number two, where do we stand with Social Security and PBGC? Consider not taking a pay raise. And we talk about that before we actually implement the plan. And number four is taking a pay cut in worst case scenario, and then implementing the plan using the guardrails and monitoring cash positions. Now, one thing you can do, now we do have some clients who we're not using this with, is because they have enough cash, they're living off cash for, to say, 3, 4, 5 years of retirement, and they're just kind of sipping off their portfolio. So if your withdrawal rate is so low that we're not too worried about you're not so worried about running out of money. We don't necessarily have to moderate in this type of situation. So the big thing about this too is if you're living off cash or your taxable income is very low in these situations, hey, bear markets are a great time to do Roth conversions. So while the market's down, take some of your tax-deferred investments in your IRA or your 401k and the PRAP. Hey, do the Roth conversions on those things while it's down. And that way, when they recover, the equity side recovers. Okay, you want to see that. And what you want to do is you want to convert the equities into that Roth conversion. The bonds won't have as dynamic of a recovery. Okay, so you want to see that recovery in the Roth accounts after you do that conversion. So those are just some things to keep in mind as you implement your retirement income strategy. So I hope that helps. This is what we do. Don't take it as tax, legal, or investment advice. You decide whether it is a good strategy for you. If you haven't done it, hit the bell icon. Remember to subscribe, hit the bell icon so that you know when new videos come out. And if you want to talk about this in your particular situation, give me a call because retirement income planning is far more dynamic. There's a lot more to consider when it comes to retirement income planning than it does accumulating assets. These are the ways we implement it. So if you want to talk about it for your situation, whether you're in retirement or coming on it, please give me a call, shoot me an email. I'd be glad to talk about it. So, hey, until next time, thanks for tuning in. I appreciate it. Fly safe.